7 questions 50% CFA Level 1 candidates failed to grasp. Context for assessing financial reporting quality. Question 7. A manager is most likely to be motivated to issue low-quality financial reports when the manager has received a fixed salary with no performance-based bonuses. B is concerned that actual earnings will fall short of analysts' consensus forecast. C has led the company to achieve the highest profit margin in its industry. Correct answer, B. Financial reports that aren't very good, like those that try to hide earnings or use accounting tricks, usually happen when managers feel like they need to show better results than they actually have to please others or achieve their own goals. The main reasons behind this are the need to live up to or even surpass what analysts predict. When companies don't quite hit these targets, it can cause stock prices to drop, hurt their reputation, and make investors lose confidence. To steer clear of these problems, managers might use some tricky accounting methods, like boosting revenues, pushing expenses back, or downplaying certain costs. For instance, a company aiming for an earnings per share EPS of 1.00, but only expecting 0.95, might jump the gun on recognizing expenses or revenues to reach their goal. Fixed salary with no performance bonuses. Managers who earn a set salary don't have immediate financial reasons to tweak their earnings. Poor reporting is often a result of variable pay, like bonuses linked to hitting targets or stock options. Without performance-based rewards, there's less incentive to change financial statements. Analyst forecasts are like the gold standard for how well things are going. If you miss them, it can lead to people selling off shares or the company being downgraded. If managers keep missing these forecasts, they might find it tough to keep their jobs or advance in their careers. When things don't go as planned, managers might try to fudge the numbers a bit to make up for it. But when they do better than expected, they might be careful and save some money for later. A. Incorrect. Fixed salaries diminish the financial incentive for earnings manipulation. C. Incorrect. High profit margins indicate strong fundamentals, reducing the need for deception. Question 6. Thumbs up and subscribe this channel. A company is performing significantly better than its internal budget and market expectations halfway through the fiscal year. The CFO is considering accelerating the recognition of certain discretionary expenses into the current period. This conservative accounting choice is most likely motivated by a desire to A. Ensure compliance with strict debt covenants. B. Avoid unwanted political or regulatory attention. C. Create a reserve of earnings to help meet next year's targets. Correct answer, C. When a company's earnings and market expectations go beyond what they planned for in the middle of the year, managers might choose to be a bit cautious with their accounting. This could mean recognizing expenses sooner or holding off on recognizing revenue. The idea is to make the earnings look better now and set aside some money for when things might not go as planned later. This approach, called earnings banking, has a few reasons for being used. 1. Smooth earnings for future goals. By lowering the earnings for the current period, managers can save those profits for when things might not go as expected in the future. This helps keep things steady and growing, which is a big plus for investors and analysts. For instance, if a company thinks it's going to make $120 million this year, but has already made $70 million by the middle, speeding up expenses by $20 million now leaves $30 million for the rest of the year. If they aim for $110 million next year, that saved $20 million can help cover any gaps. 2. Making sure you follow debt rules. Debt covenants usually ask companies to keep certain financial ratios in check, like how much interest they pay compared to what they owe. Managers might try to make their earnings look better by doing some aggressive accounting to avoid breaking these rules, not by making them better. Using conservative accounting, like speeding up expenses, would actually make it more likely they'd break the rules, so that's probably not what they'd want to do. 3. Steering clear of political or regulatory scrutiny. Companies that consistently earn a lot might catch the eye of regulators or politicians, like whispers of too much profit. But really, it's more important to focus on hitting those future earnings goals. Earnings banking is mainly about keeping an eye on how well things are going inside the company, not about what's happening outside with politics. Managers tend to focus on long-term incentives, like bonuses linked to long-term performance, rather than just short-term wins. It's better to see steady earnings growth than to have ups and downs, even if the ups are bigger in some times. If you miss future targets after doing well, it can hurt investor confidence more than if you're just a little off in the current period. A. Incorrect. Debt covenant compliance requires maximizing reported earnings, which conservative accounting hinders. B. Incorrect. Conservative accounting during strong performance periods is more commonly driven by earnings management for future targets than by avoiding regulatory attention. Question 5. A manager justifies the decision to use an aggressive revenue recognition policy by stating, "Our competitors, I'll interpret this accounting rule the same way, so it must be acceptable." This self-justification is best described as A. Motivation, B. Opportunity, C. Rationalization. Correct answer, C. The fraud triangle helps us understand why people might commit fraud or act unethically in accounting. It's made up of 3 parts. Opportunity. This is when things are set up to make it easy to misreport, like if the company doesn't have good rules or checks in place. Pressure motivation. This is what drives someone to commit fraud, like trying to hit sales goals or avoid breaking a loan agreement. Rationalization. This is the way someone might explain why they did something wrong, like saying everyone else is doing it, or it's good for the company. The manager's statement seems to offer a way to explain an aggressive and possibly not so ethical accounting move, which might not be the best approach. The manager is suggesting that competitors do the same thing, which could make it seem like it's just what everyone else is doing, or that it's okay. This might make the manager feel okay with a decision that could break accounting rules or be unethical. A. Incorrect. Motivation is not described, only justification. B. Incorrect. Manager's statement lacks explanation of enabling factors for misreporting. Question 4. A company has already surpassed its annual earnings target by the end of the third quarter. To increase the probability of meeting next year's more challenging targets, management's most likely accounting action for the current year would be to capitalize a higher proportion of development costs, B. Revise the estimated useful life of equipment upward, C. Record a discretionary write-down of obsolete inventory. Correct answer, C. Motivation, banking earnings for future periods. Given that the company has already exceeded its annual earnings target by Q3, management might choose to use more conservative accounting methods to lower profits in the current period and reserve those earnings for next year. By making a discretionary write-down of inventory that's no longer useful, we can speed up the recognition of expenses, which will lower our current earnings. This could also make it more likely that we'll meet or even surpass the more difficult targets for next year. This approach aligns with strategies for managing earnings, which are designed to make the results look more stable over time. On financial statements, current period. Expenses are higher because of the write-down, which means net income is lower. Future period. If we don't need to write down expenses next year, we'll have lower expenses, which should help our profits. Conservative accounting. It's a bit like holding back on recognizing revenue and speeding up when we recognize expenses. This helps us show lower current earnings, which gives us a reserve for when things get better in the future. It's often used when management wants to make things look smoother or to make sure we don't miss our goals. A. Incorrect. Capitalizing development costs increases reported profits, but contradicts the goal of reducing current earnings. B. Incorrect. Extending equipment life reduces depreciation, inflating profits, and contradicting conservative financial management. Aggressive accounting. It speeds up when you recognize revenue and holds off on recognizing expenses. This can boost your current earnings, sometimes at the cost of how well you'll do in the future. It's often used when management wants to hit their short-term goals or downplay any problems they might have. Real-world example. Imagine Apple writing off extra inventory of older iPhones in Q4. Since they've already surpassed their yearly sales goals, this move helps Q1 of the next year kick off with a clearer balance sheet and better growth expectations. Question 3. According to the fraud triangle framework, which of the following situations most directly represents a motivation to issue low-quality financial reports? A company operates in an industry with complex revenue recognition standards. B, a manager is concerned that missing an earnings target will result in dismissal. C, the company's internal audit function has been outsourced and is understaffed. Correct answer, B. In the fraud triangle, motivation, pressure, is all about what pushes people to commit fraud. Here, the manager's job is on the line. They could be fired if they don't hit their earnings targets. That makes it super important to boost earnings or do some sneaky accounting to dodge any bad outcomes. Career worries, like being afraid of losing their job, getting a smaller bonus, or hurting their reputation, are often what makes people feel pressured to commit fraud. A, incorrect. Opportunity in the fraud triangle arises from conditions enabling fraud, like weak controls, but doesn't inherently create pressure to commit it. C, incorrect. Weak internal audit functions increase fraud risk, but don't directly motivate financial statement manipulation. Distinction. Opportunity, the situation makes it easy to misreport. Pressure motivation, the reason you might want to commit fraud. Rationalization, the way you explain why you did something unethical. Real-world example. Imagine a manager at a company that's publicly traded. They might hold off on showing expenses or make their revenues look better in Q4. This is to avoid missing the earnings estimates everyone agrees on. They're worried that if they don't hit the mark, the stock price might drop, investors might get upset, or even their job could be at risk. This is a good example of how pressure to meet expectations can lead to fraudulent reporting. Question 2. A company's credit agreement requires it to maintain an interest coverage ratio of at least 3.0. Preliminary results indicate the ratio will be 2.8 for the current period. This situation is most likely to motivate management to accelerate research and development expenditures into the current period. B, change inventory costing methods to increase reported cost of goods sold. C, revise the allowance for doubtful accounts to a lower percentage of sales. Correct answer, C. The interest coverage ratio, EBIT interest expense, should be at least 3.0, but we're seeing a preliminary result of 2.8. Management is under some pressure to boost EBIT to meet the covenant and steer clear of penalties, like higher interest rates, loan acceleration, or a hit to our reputation. It's not uncommon for companies to make some aggressive accounting decisions, like cutting costs or boosting revenues, to give their earnings a little extra oomph. The allowance for doubtful accounts is like a guess at how much money we might not get back from customers. If we think less money will be collected, like from 3% to 2%, we'll report less bad debt on our income statement. When we have a lower expense, our net income and EBIT goes up, which makes our interest coverage ratio better. This is something management can tweak to help us hit our goals for the short term. A, incorrect. Immediate expensing of R&D costs reduces EBIT and worsens the interest coverage ratio, increasing covenant violation risk. B, incorrect. Switching from FIFO to LIFO would increase COGS, decrease earnings, and exacerbate covenant violation risk. Aggressive accounting. This approach cuts costs, like reducing bad debt or boosts revenue. It's often used to hit earnings goals, dodge breaking agreements, or show that a company is doing well financially. Conservative accounting. Here, expenses go up like increasing COGS or speeding up R&D, or revenues are downplayed. This is usually done to set aside earnings for later, earnings banking, or follow careful financial practices. but it's not ideal when you really need a quick earnings boost. Question 1. According to the fraud triangle, which of the following has most accurately classified as an opportunity that could lead to low quality financial reporting? The company operates under accounting standards with significant judgmental leeway. B. A manager's compensation is heavily weighted towards stock options. C. The company needs to secure a new bank loan to fund an expansion. Correct answer A. The fraud triangle talks about the conditions that make fraud possible, like not having strong internal controls, unclear accounting rules, or not enough people watching over things. When accounting standards give managers a lot of room to decide, like when estimating allowances, choosing depreciation methods, or figuring out when to recognize revenue, it gives them some wiggle room in how they report things. This wiggle room can make it easier for companies to do aggressive or even fraudulent accounting without anyone noticing right away, because there isn't always one right way to do it. For instance, a company might tweak its allowance for doubtful accounts by using a way too low estimate to make their earnings look better. Be incorrect. Motivation in the fraud triangle involves personal financial pressure to meet earnings targets, incentivizing managers to inflate earnings for personal gain. See incorrect. Corporate financial pressure to appear creditworthy motivates management to overstate assets or understate liabilities. But this motivation does not create opportunity. Imagine a company that's following IFRS 15, revenue recognition. They might have some wiggle room when it comes to when they recognize revenue from long-term contracts. Now, if the company is feeling the heat to hit those quarterly targets, like they're trying to get ahead, they might take advantage of that flexibility. Think of it as an opportunity to recognize revenue a bit sooner than they should. This could make their earnings look better than they actually are.